Hey, good afternoon, everyone. Good afternoon.
Definitely.
Good afternoon.
Hey, good afternoon, Rowan. Good afternoon, Alexander. Um, I see only 5 people here, but let's see how many are in the discussion board, right? We have okay, at least 6 people. So I'm missing one, right? Currently, and alrighty, I'll give a couple of more minutes
Can I
for
ask a Can I ask a
yeah,
question about the
yeah,
quiz? So the
yeah,
quiz, it's just gonna be online. We could do it anytime we want and at home, or is it gonna be in
yeah,
person?
yeah.
Oh, all right. So that's
It's on the blackboard. Look, always go to the
yeah. I saw on
first.
Blackboard that it said online, but I just wanted to make sure. So that's the
Listen,
midterm.
listen, listen. It's not any time. It's you have to do it within that window, right? 3 day window, Friday to Sunday, right? Within 3 day window, and you have like so within those 3 day window, you can choose any 120 minutes.
So I
Okay.
have to stay straight on there, right? Because last quiz
Yeah, yeah.
by accident, I kind of exited out, and I didn't know
No,
that.
you shouldn't exit. You shouldn't exit out. I mean, if by accident uh, sometimes it can happen. So by accident, connection drops. So you are, thrown out accidentally. But in that case, you gotta send me an email. But so that's why it's important to get a head start. If you get a head start, if you start ASAP, I mean, as early as you can, then something happens, then if you send me an email, I mean, you got to give me like, maximum of 24-hour response time. I may not be responding, right away,
All
right?
right.
Because I'm not checking email, every minute. So if you give me,
Mm-hmm.
so you got to give me a reasonable time to respond. And so uh, you know, um, if I find your email within the due good time, then I will reset. I will reset the exam. You can start anew. This can all happen within that 3 day window. But the worst case scenario is someone starting it at 11:30 p.m.
Mm-hmm.
Sunday night,
Yeah,
11
you're
p.m.
not getting
Sunday,
that
and then
done.
something happens, unfortunately, at that time, a lot of, internet connection problem can happen. And
Mm-hmm.
then there's no, response time for me,
So
right?
this is considered our midterm?
Uh, this is like first midterm. Okay, this is like your first midterm. You haven't had taken any test yet, right? Everything you've done so far uh, was only the self-diagnostics, right? This is the first exam. You remember, if you go
Yeah.
through the syllabus, you would know you will have 4 exams, right?
Mm-hmm.
Quiz one, midterm, quiz two, and final. So before final, all these 3 exams are like midterms. First midterm, second midterm, third midterm, right? I just
Mm-hmm.
call I just call it quiz one and quiz two because they carry 5% less weight than the midterm and the final. But they are full-blown exams, so they are like you can consider this as the first midterm. Okay. Alrighty. Any other questions? I'm so more people are joining. So let's pick up from where we left off last time. In the last class, I think we were talking about how the prime straight node works, right? Remember, uh, uh, okay, we were talking about the, oops, right? In the balance sheet, on the asset side, right? The current fixed assets or non-current assets, real assets, physical assets, they are, quite obvious. It's plant and equipment, building and land, right? Whereas, current assets, cash and cash equivalent, I explained everything else. Now, promissory notes and accounts receivable. And so I told, I already went over promissory notes. So it's because, they want to, the buyer, especially in B2B, buyer doesn't want to pay with cash immediately. I mean, eventually they will have to pay out cash, but they want to buy time. They want to buy time, right? So they want to defer payment as long as they can. That's called, opportunity cost. I mean, if they defer payment, if they make immediate cash payment, there is opportunity cost for doing that. The opportunity cost is the what you could have earned with that cash, right? If they didn't pay with cash. I mean, if they defer payment for 60 days and pay with promissory note, then they are they have the use of that cash for 60 days, and during those 60 days, they can take on an opportunity to make an investment for 60 days, and if that gives you 10% return, why you would rather want to do that. And if you think about it, if you make cash payment, you will be foregoing that opportunity. That opportunity will be lost, right? And then so 10% return on an investment is the called opportunity cost, right? That's what you could have made, right? Using that foregone opportunity. I mean, if you had used that opportunity, right? So they all want to basically nobody. Everyone wants to minimize that opportunity cost, right? Always the decision is made in the way that minimizes the opportunity cost. So one of the reasons they use promissory note is to minimize the opportunity cost. But anyway, the bottom line is, so I used this example last time. So if Dell, so if Best Buy, between Best Buy and Dell, if Best Buy bought 1,000, right? If Best Buy bought 1,000 computers from Dell at $300 each, right? And that $300 is basically cost for Best Buy, but that's the price for Dell. And because it's 1,000 units, the total will be 300K, right? Total will be 300K, right? I know. This stylus is really not really bad. Okay, I'm gonna have to. This is almost. So this, 300K is basically the for Best Buy, it's the CGS, right? Cost of goods sold. But for Dell, it's revenue, right? Okay. And then, but they paid with promissory note, and the promissory note, so with the 60 days to maturity, right? At 10% APR. So they have to pay interest on this because it's like compensating for from Dell's perspective, they are missing out on the opportunity that they can make the opportunity. They are missing out on the opportunity where they can make, like 10% return over just 60 days, right? Um, so the promissory note, the maturity value or the future value of the promissory note can be calculated this way, right? First, the maturity value, right, is 300K, right? The principal or the face value. Now, it's 300K, and then there's 10% APR, right? So times 1 plus 10%, but this is APR. 10% is for year, but the length of the promissory note, or the time on this promissory note, is only 60 days, right? So what do? They will have to. You cannot multiply that by 60, because 60 is then it's like 60 years, because you cannot multiply annual rate, right, to you cannot multiply annual rate by 60, because that's like 60 years, right? Because the rate is annual. So 60 days, how do you adjust it? You will have to make an adjustment. It's clear. So 60 days is 60 divided by 360 in years, right? You'll have to and someone might ask, why not 365? I'm going to explain it later, because and in the main lecture video, it's all well explained. 360 is called ordinary interest year, right? And that's the default, right? You can use also, if you can use 365 as well, which is called exact interest year. But from the if you are Dell, you wouldn't want 365. You want 360. From the one who receives the interest, you want the denominator to be smaller, because smaller denominator will always result in a bigger fraction, right? Bigger fraction will translate into bigger future value or maturity value, bigger interest, so bigger future value. So if you do that, it comes to 305K. So that's the maturity value, and that means at maturity, meaning if you hold it for 60 days, and this is Dell. Dell is a big company. So they can hold it for 60 days, and then they present it to the Best Buy, the issuer, and then they will collect 305. But this is not always the case for a small manufacturer. For a small vendor, they cannot wait 60 days, because small businesses are constantly suffering from cash flow shortage, right? Small businesses. So for small businesses, it's really hard to, if they keep holding it for 60 days, then they might go bankrupt. They will have to default. I mean, all the companies have, think about it, all the companies have, even the small seller, small vendor, forget about Dell. I mean, Dell is a big company, so Dell won't go down. for, they won't default even when they have outstanding payments. But think about it. All the companies have some kind of all the companies have accounts. What is this? Why is it? Oh, because it's a pencil. Oops. All right. See, all the companies have current liabilities or short-term debt, so they mature, right? Short-term debts mature anytime within 1 year. So it can be, next week, next month, two weeks from now. When you cannot meet these payment obligations, then you can go bankrupt. And that's the situation. That's the reality of small businesses. They are constantly short of cash flow, so they don't have the luxury of holding it. They don't have the luxury of holding it for 60 days. So what do? They take it to the bank and then sell it to the bank. I mean, this can happen on day one or day 10 or day 20, day 30, at any point. But most small businesses just take it to the bank on the day one. And if they take it to the bank on the day one, um, or day 10, last time I used an example of day 10. If they take it to the bank on day 10, the uh, bank is taking over this risk. I mean, think about it, holding a promissory note, holding any financial asset, including commercial paper, bonds, they all carry risk. Risk of what? Default risk. I mean, always keep in mind, there are four types of risks in lending, right? Most obvious risk is the default risk, and then inflation risk, liquidity risk, and then what? Maturity risk, right? Default risk is always something you need to consider. So in case of Best Buy, Best Buy is a company with a good credit rating. It's not likely that they will default on their promissory note. But still, there's a risk. Still, even however small it may be, right? So they cannot uh, uh, they they cannot give them full maturity value of 305K, because on day 10, from day 10 to day 60, there's 50 days, and the bank is taking over that risk for 50 days. So the bank will have to get something out of this. They need to get compensated for the risk for 50 days. So they discounted. Uh, 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 they discounted by some discount rate, applying some discount rate, and then they arrive, so um, they pay them, for example, something like 301K, right? The bank pays, Dell 301K. Um, and then the difference of 4K, that's what the bank takes. That's called, bank discount or simple discount. Simple discount or bank discount. And it's called the simple discount because you're using simple interest rate method, right? Simple interest rate method. And okay, so simple discount. And then, this 301K is called proceeds. That's what goes to Dell or the seller or the recipient of the promissory note. Now then, the bank holds it until day 60, and the bank presents it to the issuer, right? Bank presents it to the issuer, which is Best Buy. So bank then receives 305. So bank paid out already 301K 50 days ago, and the bank collects 305. So 4K is the bank's cut for taking the risk, right? In case the issuer of the promissory note defaults, then at least if they really default, of course the bank will the bank is the bank has incurred the loss of negative 301, right, K. But in that case, the bank will proceed to seize the assets of Best Buy if Best Buy doesn't pay, right? But it's a legal action, so it will take they will have to file a lawsuit, right? To so in this example, what the bank did was called factoring. I mean, a factor is a usually it's it can be a bank or a financial company that specializes in financing company that specializes in promissory notes and invoices. Okay. Basically, this process is called, factoring, and then the origin of the word, the etymology, you might, it's quite interesting because you might think, oh, it must be the same thing as, the word factor in a sentence like, we perform the factor analysis, or, multiply this by factor of 10, or factorization. I mean, the word factor here, it comes from a complete different origin from those usages. Okay, why? Because actually it comes from the French la facture. I just got confused because in Italian it's called I think in Italian it's also a feminine noun. La fattura. La fattura is Italian. I think in Spanish it's la factura. And what does that mean? They all mean invoice. Okay. Now, even in Czechoslovakian, right? Even in Czech, it's factura. And this was quite, it was very curious thing, because Czech, I mean, between Romance languages, French, Spanish, Italian, Romance languages. So there is, obviously cognates. They must have, same the words that came from the same root. They share the same root. But Czech has a complete different root because Czech is a Slavic language. So Czech is similar to Russian. One thing I could tell was, when I was in, Prague, um, on the river. That's Danube basically. But they call it Vltava, or I mean, it the river Danube is called goes by many different names: Moldau, Vltava, or But there are many bridges across the river, and they are all called most. Most is a Slavic word for bridge. Most. Karlov most. Karlov most is Charles Bridge. Um, so basically, it's a Slavic language, and other Slavic languages, invoice different. Russian invoice in Russian is different. Um, and in German, it's totally a different word. But then in Czech, it's faktura. Of course, it's possible because even though it's a Slavic language, some vocabularies are borrowed from a different language, right? Uh, but from this, it's quite obvious what's the origin of the word factoring, because when this word came into English, right, it got anglicized and became factor, right? So that means invoice. The word means invoice. So this, now that also then applies, this simple discount method, or bank discount method, applies not only to the promissory note, it applies also to the invoice, right? It applies to the invoice, all the same. Now, if you think about it, accounts receivable and in promissory notes, exactly, they are both credit sales, right? Isn't that right? They are both credit sales. But what's the difference between the two? Um, one is initiated by the buyer, and the other one is initiated by the seller. So promissory notes are initiated by the. It's a credit sale initiated by the buyer, right? You didn't, no. As a seller, nobody chooses to or prefers to receive promissory note. If possible, they want to avoid promissory note. But for a long-term business relationship, they will have to swallow it. Whether they like it or not, they will have to swallow. They will have to swallow it. But accounts receivable is a seller-initiated credit sale. Usually, the the way think about it, between the seller and the buyer, right? When the buyer orders, the seller delivers, but they don't pay immediately. The seller just drops it off. In B2B, in business to business, right? Seller drops it off. I mean, so it's not just one single item. The whole order, a whole crate full of a whole crate load of big box, whole crate load of big box, and inside a lot of parts and components, right? You drop it off at the buyer's warehouse, and they just drop off the invoice. They just send the invoice. Pay within 30 days. Pay within 60 days. So think about it. This is, seller-initiated credit sale, right? So then think about it. We know promissory note is easy to understand. I mean, it's not only the concept, it's not only a concept, but also it's not only a concept, but also a physical form. Promissory note is a physical thing, not only the concept, but also a physical thing, right? But accounts receivable is only a concept, right? It's only a notion. It's only a concept. And think about it. Then, what is the physical form of the accounts receivable? What's the physical form of the accounts receivable? Invoice is the physical form of the accounts receivable, right? So then, what they do is just like the promissory note, they take it to a factor, right? They take it to a factor, like a bank or a financial company, and then they sell it. They sell it to the factor. So when they sell it to the factor, right, then it gets discounted exactly in the same way. So therefore, if you think about it, in factoring, right, invoice is critical, right? Invoice is critical in factoring. Okay. All righty. Now, so that explains everything about the current assets. Now, let's take a look at the current liabilities, which are short-term debt, and we have accounts payable, notes payable, interest payment, and accruals, right? Accounts payable is basically invoices. If you are the buyer and you receive the invoice, that's your accounts payable. And notes payable is also as your payment obligation, right? Because you bought something with promissory note, and that's your notes payable, right? And then there's interest payment. Of course, and this number, think about it. This should be the same thing as the interest in the income statement. And at the beginning, I told you, they because income statement and balance sheet have different goals, different purposes, right? The line items, all these line items are all different, right? And being able to distinguish between, being able to discern and distinguish between income statement line items and balance sheet line items is a very fundamentally crucial abilities, right? If you are in this field, if you are going to continue with the finance field, this is a critical ability, right? Being able to distinguish between these two line items in these two different statements. And at the beginning, I told you although they are all different, only two items are the same. They share two items. One is interest, and the other one is depreciation. Depreciation appears here, right? And of course, although it is zero here, if there is a depreciation here, they should match. There's no depreciation in this example, so nothing there. But depreciation. I'm not looking at. Yeah, here, nothing here, right? Nothing here. But if there is something, if the depreciation is, I put it 0, but maybe I can, if this is non-zero, right? If this is depreciation, yeah. Oh, no. If you have, and that should be negative here, negative. And the same thing must be reflected here, right? So interest and the depreciation are the only two items that are common, that are shared in common between, income statement and balance sheet. Yeah. So we understand, account all of the line items in the short-term debt or current liabilities. One thing we still need to be, one thing that needs to be discussed is the accrued wages, accrued taxes. And what is accrual? What's an accrual? Accrued. Okay, accrual. Now think about it. Everything that is entered, all these data, right? All these data entered in the balance sheet and income statement are the result of completed transactions, right? Think about it. Sales revenue is the result of completed transaction. As of the end of the first quarter, sales revenue was like this. Returns and allowances, everything is, CGS. It's the end result of completed transaction. End result of completed transaction, right? But then there are things that are not completed. For example, if you work, and most likely you will get a bi-weekly paycheck. Paycheck is bi-weekly, right? I mean, you can get a monthly paycheck or bi-weekly paycheck. And if you get a bi-weekly, it's usually on Friday. You get, right? Friday. But think about it. All these statements are closed at the end of the month, not just at the end of the month. I mean, at the end of the quarter, right? They close it at the end of the quarter. In other words, they have to collect and compile all the data and close the accounts as of the end of the quarter. End of the quarter is, end of a particular month. Isn't that right? End of first quarter is end of March. End of the second quarter is end of June, right? And so on. But end of the month is not always Friday. Sometimes the end of the month is Monday, sometimes Wednesday. Suppose the end of the month was Wednesday, right? And then during that week, your wages or salary, you worked Monday, Tuesday, and Wednesday. So the company owes you the salary up to Wednesday, right? But then they don't pay you on Wednesday. They don't pay you on Wednesday. It's obvious. It will have, but that's the end of the month. That's the end of the month. And the new month begins. And until, Thursday, until Friday, you don't get paid. So only when you get paid, then this transaction is completed. And wages paid, right? Biweekly paycheck has been paid. Does that, so think about it. If only the completed transactions enter the statement, then there is no way of, entering the paychecks, the wages that have not been paid yet, but has accrued, right? So it's incomplete transaction. Accrual is an incomplete transaction, incomplete. Right? Paycheck has not been paid. The paycheck isn't paid on Wednesday, so, but wages have accrued until then, and you have to declare it. You have to show it on the balance sheet as it's a liability. So liability, right? There it goes. The liability, right? Short-term liability. It makes sense. That's what is what is meant by accrual, right? Accrued wages. So that explains everything about the balance sheet, right? Here, one thing, but then you might remember the whole when we started on the second topic, I said clearly that this is microeconomics perspective on return on investment, micro perspective on ROI. In other words, from the firm's perspective. From the firm's perspective, right? ROI, how do we measure ROI, return on investment? So that's why I said it's microeconomics perspective. From the company's perspective, two things, return on assets and return on equity, right? That's how the firm views ROI as, okay? So to explain, it's almost 3:50, so we'll take a 10-minute break, and when we come back, then we're gonna go talk about ROA and ROE, all right? So let's take a 10-minute break, okay? Yeah, Daniela, you have a question, but Daniela, we're gonna take a break, so can you hold it until?
I have a question about the test, the upcoming test.
Yeah. Yeah,
What's
yeah, yeah.
gonna
Go
be
ahead.
on it? Like, what topics is it gonna cover? Is it gonna cover fast
Topic one and
learning?
two. Topic one and two. Topics one and two.
Okay, so it's gonna be ROI.
ROI
Is
and financial
is
statements.
what is to expect on that test?
Well, you can expect everything that can arise from these two topics.
The topic.
Mhm.
So I have the textbook, and the first two topics are. One second.
Look, the textbook is the first topic in the textbook is uh, a very
Financial markets.
yeah, yeah, yeah. It's not the same. Look, the don't go by the textbook. I mean, it's only a small part of the chapter one coincides with topic one. Topic one is my original material. The only the only portion that coincides with my topic one is um, uh, only uh, uh, the only like risks, risk part, in inverted yield curve, uh, so it's not exactly my like my topic one. Okay. um, Topic one. So basically, the custom edition is a uh, especially chapter one of the custom edition is a compilation of uh, compilation from three different books. So um, uh, it's not the same thing. Okay. Look, listen. If you have any further questions, hold it until we come back from the break. Now, that way, it's 3:51, so we'll reconvene at um, 10 minutes later, right? 3:52 now, so 4:02. Okay, you are. Uh, I need a break because I cannot speak for long. I need to give my throat. I need to give my voice a break as well. So hold it until after the break. Okay. Any other? Okay. We'll go to break first. Okay. All right, we're back. We're back. I just sent out, especially for, I mean, since some of you seem to have a question about what topics are covered, um, and I just sent out a new message. This is you can find this also on the announcements. Please check it out. This explains, basically, the difference between my topic one and chapter one in the book. Okay. All righty. So, any other questions? Any other questions before we proceed? Any other questions? All righty. If you don't have other questions, then let's go on. Let's think about what ROA and ROE are. So ROA is basically return on assets. ROE is return on equity. Now, think about it. This will be a good analogy. Mouse is stuck. A company. I've been telling you that the company is like a vehicle. A firm is like a vehicle to transfer the profit to the owners, the shareholders, right? But also, a firm is a firm is a firm consists of assets, right? And what's the purpose of an asset? What did I say? How did we define assets? Assets can be defined on three levels, but what's most important is that the assets must have income generating capability, right? So a company is like, it can be considered like a tree, apple tree, let's say an apple tree, right? So let's say this is an apple tree. An apple tree is like an asset. It's an asset. Why? Because in the fall, it's gonna bear apples, right? Apples are basically, the fruit of the tree is like the profit, isn't it right? The fruit of the tree is like the profit. So basically, if you're a farmer, you're tending to this apple tree because you water it, you fertilize it, so that the tree will bear a lot of fruit in the fall, right? So and this is your this is the output, right? Fruit is the output of the tree. The tree is basically the what? Tree is your asset, or it is also you can consider it as input, right? In other words, your initial investment, your dollars, right? If the apple tree is like $1,000, right? Or let's say $1 million is an apple tree that bears golden apples, right? It could be worth $1 million, right? It could be probably worth $1 million. Let's say 1 million. 1 million is your initial investment, and it's your input, and that $1 million bought this total assets, right? And then from the total assets, the apples are the output of those assets, right? And your assets actually break down into, we all know assets break down into equity and debt. And think about it. Um, um, what should be the output? What should be the output? Whatever it may be. It's like this. The productivity, the productivity of your asset or the productivity of your apple tree can be measured by how many apples, I mean, the dollar value. Output can be translated into the dollar value, right? Output can be translated. So if there are, like 1,000 apples on the tree, and if each apple is, $10, or each apple is $100, then the output is $100,000, right? The output is $100,000. Each apple being, $100. I mean, if it is golden apple, right? If it is golden apple, each apple is $100. So to measure the productivity or the profitability of this apple tree or your total, you would have to divide your, you'll need to divide the output by input. I mean, think about it. There's no argument or dispute about this. This is how you measure productivity, output over input. This is also called, output to input ratio. What else can it do better, right? Also, the productivity is closely related to efficiency. What is efficiency? Now, the productivity can be low or high, and the higher the productivity, the more efficient it is. The lower the productivity, the less efficient it is. One very good example is gas mileage or fuel economy. What's fuel economy? You all know how many miles per gallon, how many miles the car got you per gallon, right? That's the fuel economy. And think about it. Some cars are gas guzzlers. I believe, something like, Ford Expedition or, the big trucks like Ford F-150, basically it's the same chassis, same body, same chassis as Ford Expedition. Expedition is SUV. F-150 is like, it's a truck, but they use the same chassis. And but they are gas guzzlers, right? They are like, dinosaurs that just guzzles, guzzles up the gas. And something like, Cadillac Escalade, right? Also a gas guzzler. They get, only like 5 miles per gallon, right? 5 miles per gallon. If you have a truck or SUV like that, you can't complain about the gas price because, you're not someone who cares about, fuel efficiency at all, right? And if you get some hybrid car, hybrid, Prius or, whatever, the hybrid. There are many hybrid cars these days. Kia, and the hybrid cars can get, like at least 50, like 50 miles per gallon, or 60 miles per gallon. Now, if you get 50 miles per gallon on your hybrid car, that's 10 times more efficient than Ford Expedition, right? And that's fuel efficiency or fuel economy is something that you look into, something that you focus on when you buy a car. I mean, that would be probably the priority, right, that you will look into. And so the gas mileage is like the productivity of the car, right? And if your gas mileage is 50 compared to Ford Expedition that gets only 5 miles per gallon, or Escalade, Cadillac Escalade, um, your your car is definitely more efficient, way more efficient, right, than those big SUVs and trucks. So everything, basically the productivity, the only way to measure the most uh, solid way and the solid way and the invariable way to measure the efficiency is output to input ratio, right? And then if you think about it, we already know what is, we already know what is ROA. ROA is basically, okay, what's the output? Profit, right? And what's the input? Total assets, right? And return on equity. So, but from the shareholders' perspective, in other words, from the equity holders' perspective, because equity holders are the owners of the company, from the equity holders' perspective, they would rather want to know the productivity of the equity. So the output is, of course, and then you divide it by equity. Okay. So these are the way they, the returns measure. These are the returns measure they use most frequently for the firm. Again, because think about it, this profit only belongs only to the shareholders, right? Because shareholders, the equity holders, are the owner of the company. Debt, although total assets came from both equity and debt, debt holders have no claim on profit, because for debt holders, as long as they get back their interest and principal, right? That's it. Their cut is only interest, right? They don't, right? They have no claim on profit. So from the equity, from the debt holders or creditors or bondholders, it's the same thing, right? Goes by uh, the holders, debt holders, bondholders, creditors, and lenders. They all mean the same thing, right? So from the debt holder's perspective, this doesn't help them. I mean, it doesn't completely, it's not that it is useless to them. At least, they would lend to the company that has high return on assets, right? But the point is, they can use this as a rough measure, but there's a better measure for the debt holders, for return on assets to be more meaningful to them, for the debt holders, right? Return ROA better be revised to reflect EBIT rather than net profit. Rather than net profit, it's more relevant for the debt holders to use EBIT, right? More relevant to use EBIT for the numerator, right? Because EBIT is the EBIT has interest in it, right? Which is their claim, right? Which is their claim, right? So there are two versions. There are two versions to ROA. One EBIT over total assets. The second version, net profit or EAT, right, over total assets. Now, but if we use this version, right? If we use this version, this is just a really, this is almost like an IQ test, just logical reasoning test. If you the same for the same company, right? For the same company, and if you use this version of ROA and ROE, which one will be greater? Right? Which number will be greater? Right? The question is it going to be like this or is it going to be like this? Which one is greater? Anyone? Is there anyone who can answer this question? Why everyone is so quiet? This is a yeah, Cedric, your microphone is on. Cedric, are you there? Cedric, can you answer this? Cedric, are you saying something? I mean, your microphone is on. I see your mic is on, but I can't hear nothing. You got to check the volume on your microphone.
Professor.
Yeah, is it Usman?
Oh yeah. Can you repeat the question again?
The question is, if you use this version of ROA and ROE, right, for the same company, of course, we're talking about the ROA and ROE of the same company. Which one is greater? Which one should be greater, ROA or ROE?
ROA.
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 Okay, who said ROA? There's Usman
Usman
And
and who?
Daniela.
Daniela. I'm afraid I can't give you points because that is wrong. Okay. And if it is wrong, I cannot accept any more answer because if you say ROE, if that is wrong, then, of course, then the only answer is ROE. ROE is greater. Why? Think about it. It's logic. Um, for the same company, we're talking about the same company, so the profit is the same thing, right? Profit, the same, right? So same numerator, but then with, about the denominator, total assets and equity, which one is greater? Hmm? Which one is greater? Total assets between total assets and equity. Huh? I mean, total assets is greater than equity. Of course. Why? Think about it. Total assets is equity plus liabilities and debt. Equity plus, liabilities. Right? Isn't that right? I mean, assets are equity plus debt. So always assets are greater than equity, total assets, because equity is only a part of one component of total assets. So it's a simple thing. When you divide the same number, right? If you divide the same number by something greater, right? Total assets, then it should be smaller. The whole fraction will be smaller than dividing the same numerator by something smaller. Isn't that right? That's just the logic. So everyone can understand this. Everyone has understood this. I don't hear, how come I hear no response? Everyone understood this?
Not really.
Okay. Again, so Melody, so pay attention. ROA and ROE of the same company, one company. It's the same company, so the profit cannot be the different thing. You are looking at the same profit, right? You're looking at the same profit, okay? And you're only dividing it by two different numbers. You're only dividing it by two different numbers. Same profit. ROE, you divide it by equity. ROA, you divide the same numerator by total assets. Then think about it. Total assets is always supposed to be greater than equity. Isn't it right? Melody, do you follow? Are you following? Total assets cannot be smaller than equity.
I'm here.
Yeah. Total assets cannot be smaller than equity because total, by definition, total assets is equity plus debt. Right? Because total assets is equity plus debt, total assets is greater than equity. So when you divide the same numerator by different denominators, when the denominator is smaller, this is smaller, right? This is bigger. when you divide the same number, same numerator, by a bigger denominator, the whole fraction gets smaller. And when you divide the same numerator by a smaller denominator, then the whole fraction gets bigger, right?
Okay, I
Does that
follow
make
now.
sense?
Yeah.
Okay. Yeah. This is just the logic, right? So then that's why RO, this, this is wrong, right? Only, ROE will always be greater than ROA, okay? As long as you use the same, numerator. Of course, you cannot always guarantee that when you use EBIT for ROA, but most of the time, still ROE will win out. Okay. Ah. I don't know what to do. When I open the window, it's not that cold now. But when I close the window, I don't have any blind on my window right now, so I'm getting a lot of heat, a lot of sun through the window. The next thing, let's take a look at this. All right. Let me. So actually, when we maybe it's better using this. So when we do the fundamental analysis, it's called, fundamental analysis. Basically, analyzing the income statement and balance sheet is called, fundamental analysis. And when we do fundamental analysis, we need two balance sheets and one income statement. Why? Of course, we need we need balance sheet at time 0 and balance sheet at time 1. Okay? And the income statement is income statement at time 1. Why? Think about it. The balance sheet, we need to have the balance sheet at time, at the beginning. Time 0 means, at the beginning. Time 1, something like a year later, right? I didn't put, I put only one balance sheet here, but think about it. We'll need two balance sheet at time 0 and time 1. Otherwise, it's not, meaningful, because we want to know how much change has happened. We need to know, we want to know how much change has happened in 1 year, over 1 year period, right? And the change is what caused that change is mostly reflected in the comes from the income statement. For example, between the balance sheet at time 0 and balance sheet at time 1, everything has, basically current assets at time 0 and current assets at time 1. There must be a change. There must, something has happened. It must have, it could have, the line items, that delta is always change, right? There has been a change in the line items, right, that make up, and also fixed assets or non-current assets at time zero, non-current assets at time one. There has been a change, and especially what you're interested in is the equity, right? Equity level or equity position, right? Equity at time zero, let's say if equity is $60 million, right? And let's say number of shares, $1 million, let's say 1 million, right? Number of shares is 1 million. Then, what is the price per share? If the equity at time zero is 60 million and there are 1 million shares outstanding, what is the price per share? Anyone? Is this that hard?
Is it 60?
Yeah, it's 60. Yes, of course, it's 60. Because, there are $60 million. $60 million is called paid in. This is paid in capital. In other words, at time zero, they sold 1 million shares at time zero. They sold 1 million shares. So paid in capital. And each share is sold for $60, right? Each share is sold for $60. So the price per share is $60, right? That's not difficult, right? That's called, actually that's called book value per share at time zero. And who was that? That was Daniela, wasn't it? Who said that? Wasn't it Daniela? Hello?
Yes, Professor?
Yeah, then promptly, right? Respond promptly. I'm trying to give you extra points, and if you are just, if you are so slow in responding, then
Sometimes it's the reception, Professor. We have bad reception.
huh?
I
The
said
reception is
sometimes it's
not
the
good?
reception is not good. You can see like somebody's on, but then the connection is not good. Sometimes I have to keep going
Ah,
offline to come back online because you sound like a
ah,
robot.
oh, okay. So anyway,
Yes, that did happen.
section 1500. Okay, Daniela. Um, are you guys in the are you guys in campus? Are you guys in campus?
Yes, we are.
Oh,
Sorry. It takes.
why? Yeah. I mean, as I said, we're gonna meet online until further notice, and I don't know, maybe you have another class, in person on campus, so that's probably why you're coming there. But if you are connecting from home, you might get a better, connection. Now, so Daniela, I'm giving you, 1 point for that answer. So that's called, where's my stylus? That's called book value per share at time zero. And the book value per share, literally, that's the price per share on the book. This is not the market price. Market price can deviate. Market price can market price can be different, right? Okay, P is the market price, and the market price can be different from 60. I mean, it can be greater than, in other words, it can be greater or less than 60. Because market price fluctuates, every minute. And, market price is determined by demand, actual transaction, demand and supply, right? But the book value is literally based on the solid data. In other words, whatever, was paid in, whatever was the paid in capital, equity capital, right? You divide it by the number of shares, and then that's the book value per share. Now, 1 year later, what's going to be the equity at time 1? 1 year later, we don't know. It depends on actually, but at least one thing hasn't changed. Number of shares, right? Number of shares is still 1 million because number of shares doesn't change, right? Unless they sold new stocks, number of shares don't change. And they don't sell new stocks that easily. They can't sell new stocks that frequently because existing shareholders don't like it. Existing shareholders don't like the company to sell more shares because if they sell more shares, it's going to dilute the share price. So actually, this is an important part, but we ran out of time. So that's all the time we have. We're going to talk more about this on Wednesday. Okay, we're going to have more time, and we're going to wrap up everything about, topic 2 on Wednesday. Okay, so that's all the time we have. I'll have to call it a day. Have a great afternoon, everyone. Looks like it's a gorgeous day out there. Any questions? Any questions so far? Any questions? Any questions? Okay, if you have no questions, then I'll stop sharing and stop recording.